Something unusual is happening in the global financial system right now. While stock markets swing wildly and headlines argue about interest rates, two assets are quietly sending a very loud signal: gold and silver. Gold has surged past $5,000 per ounce, a level most analysts once called impossible. At the same time, silver has climbed to multi-decade highs, moving faster than almost any major asset on the planet. This is not normal price action, and it is not random. Whenever gold and silver move like this together, history tells us one thing: something deeper is breaking beneath the surface. Now here's the part most people miss. This rally is not being driven by retail investors. It is not being fueled by hype on social media, and it is definitely not about short-term speculation. This move is coming from the top of the financial system: central banks, sovereign funds, institutional money, the same players who have access to the best data, the best forecasts, and the clearest view of global risk. And they are buying precious metals at a pace we haven't seen in generations. So the real question isn't why gold is rising. The real question is, what are they preparing for? Because gold doesn't surge like this when confidence is high. Silver doesn't explode when the system is stable. These assets rise when trust starts to weaken. Trust in currencies, trust in governments, trust in the future. Right now, the world is facing a rare combination of pressures. Geopolitical tension is rising across multiple regions at once. Trade routes are being weaponized, tariffs are returning, and global debt levels are sitting at historic extremes. At the same time, the US dollar, the backbone of the global system, is showing cracks, not collapsing, not crashing, but weakening in ways that matter. When currencies lose purchasing power, when governments print more to manage debt, and when uncertainty spreads, money looks for safety. And for thousands of years, safety has looked like gold. Silver follows because it lives in two worlds at once: part money, part industrial lifeline. What makes this moment different is how fast this shift is happening. Markets are not panicking, yet gold is behaving as if something has already gone wrong. That disconnect is your warning sign, because historically, precious metals don't react to what's happening today. They react to what's coming next. To understand why this precious metal rally matters so much, we need to look at who is actually buying. Because this is not a wave of everyday investors rushing into gold shops. The data tells a very different story. The biggest buyers right now are central banks. Over the past few years, central banks around the world have been accumulating gold at record levels. Not gradually, not cautiously, but aggressively. Countries that once relied heavily on US dollar reserves are quietly diversifying away from them. Why? Because holding dollars today comes with a growing problem: debt risk. The United States is running massive deficits year after year. Servicing that debt requires either higher taxes, higher interest rates, or more money creation. None of those options are painless. When governments print money to manage debt, the value of that money slowly erodes. Not overnight, but steadily. Central banks understand this better than anyone. That's why they are shifting reserves into assets that cannot be printed, cannot be frozen, and cannot be politically controlled. Gold fits that role perfectly. Silver, meanwhile, plays a different but equally important role. Unlike gold, silver is deeply embedded in the modern economy. It's critical for electronics, renewable energy, medical equipment, and advanced manufacturing. As global supply chains fragment and nations race to secure strategic materials, silver becomes both a monetary hedge and an industrial necessity. That dual demand creates pressure from two directions at once. Now, add another factor: interest rates. For years, rising rates were supposed to be bad for gold. Yet gold kept rising anyway. That alone tells you something has changed. It suggests that markets are no longer focused solely on yield. They are focused on risk. When investors begin prioritizing capital preservation over returns, gold thrives. And that brings us to the most important signal of all. This rally is happening without panic. Stocks are volatile, but they haven't collapsed. Banks are under pressure, but the system hasn't frozen. The economy looks fragile, but still functioning. Gold is acting as if markets are already positioning for the next phase. Historically, that's when precious metals are most dangerous to ignore. Because once fear becomes visible, prices usually move much faster and much higher in a very short period of time. This doesn't mean the system is about to collapse tomorrow. It means smart money is preparing early, and early preparation is how wealth survives periods of transition. To fully understand why gold and silver are sending such a strong signal, we need to talk about the US dollar. Because every major move in precious metals is, at its core, a statement about confidence in currency. Right now, the dollar still looks strong on the surface. It dominates global trade. It remains the world's primary reserve currency. And it continues to sit at the center of the financial system. But strength on paper is not the same as trust in practice. Behind the scenes, something subtle is happening. Countries are still using the dollar, but they are trusting it less. This shift doesn't show up in dramatic headlines. It shows up in behavior. Central banks are holding fewer dollars as a percentage of their reserves. Trade agreements are increasingly structured to avoid direct dollar exposure. And governments are preparing backup systems for settlements and payments. None of this means the dollar is collapsing. What it means is that the dollar is being hedged against. And when global institutions hedge currency risk, they do it with gold. Gold is not someone else's liability. It doesn't depend on policy decisions. It doesn't require trust in political stability. That's why, historically, every major period of monetary stress has been accompanied by a surge in gold demand. Silver follows because it reflects a different concern: economic strain. When industrial demand for silver rises alongside monetary demand, it signals that nations are preparing for a world where supply chains matter more than financial efficiency. This is exactly what we're seeing now. Trade is becoming regional. Manufacturing is being reshored. Strategic resources are being stockpiled. All of that requires silver, so when both metals rise together, they tell a dual story. Gold warns about monetary confidence. Silver warns about economic fragmentation. Now, let's talk about why this matters to ordinary people. Currency debasement doesn't look dramatic at first. It shows up quietly, through higher prices, shrinking purchasing power, and the slow realization that money buys less than it used to. You don't notice it in a single transaction. You notice it over years. Gold and silver rise, not because inflation is visible today, but because it becomes unavoidable tomorrow. Markets don't wait for official confirmation. They move ahead of it. That's why precious metals are often called a leading indicator. They react before policy changes, before recessions, before confidence breaks publicly. And right now, that indicator is flashing. One of the most confusing things for investors right now is this: if the risks are so serious, why haven't stock markets collapsed? Why do indices still appear resilient, even as gold and silver surge? The answer lies in distortion. Modern financial markets are no longer driven purely by fundamentals. They are heavily shaped by policy support, liquidity injections, and expectations of intervention. Whenever markets show signs of stress, investors assume central banks will step in. That assumption changes behavior. Instead of pricing risk honestly, markets delay it. Stocks don't crash immediately. Bonds don't reprice smoothly. Volatility becomes erratic rather than decisive. This creates a strange environment where traditional signals fail. Bonds are supposed to offer safety. Yet government bond markets are struggling under the weight of rising debt and massive issuance. Stocks are supposed to reflect growth, yet earnings are increasingly dependent on financial engineering rather than productivity. In that kind of environment, investors look for assets that sit outside the system. Gold and silver don't rely on earnings. They don't depend on interest rates. They don't require trust in institutions. They simply exist. That's why precious metals often perform best during periods of uncertainty rather than outright crisis. They thrive when markets feel uneasy but not yet panicked. This also explains why this rally feels quiet. There is no euphoria, no retail frenzy, no mass media excitement. That silence is important. The most powerful market moves often begin without noise. By the time everyone is talking about them, the opportunity has already shifted. Now consider this. If stocks eventually correct, investors will look for places to park capital. If bonds lose credibility, alternatives become limited. If currencies weaken gradually, hedges become essential. Gold and silver sit at the intersection of all three risks. That makes them not just defensive assets, but strategic ones. This doesn't mean every investor should abandon stocks or panic into metals. That kind of thinking leads to poor decisions. What it does mean is that ignoring the signal entirely is dangerous. Markets rarely send the same warning twice. And right now, precious metals are signaling that the era of easy confidence is ending. History gives us a powerful lens for understanding moments like this. Whenever gold and silver enter record territory together, it usually marks the beginning of a transition, not the end of one. This pattern has repeated itself more than once. In the early 1970s, gold surged after the global monetary system was quietly rewritten. The break from the gold standard didn't cause immediate chaos, but it reshaped currencies for decades. In the early 2000s, gold began rising years before the financial crisis became visible. It moved steadily while markets dismissed the warning signs. And after 2008, precious metals climbed again as governments responded to crisis with unprecedented money creation. In each case, gold didn't rise because the system collapsed overnight. It rose because the rules changed. That's the key distinction many people miss. Markets can function, economies can grow, stocks can rise, all while underlying monetary confidence slowly erodes. Silver's role in these periods is especially revealing. Because silver reacts faster and more violently. It reflects stress not just in money, but in production, energy, and technology. When silver accelerates, it usually signals that economic efficiency is giving way to resilience. Countries begin prioritizing security over optimization. Supply chains become redundant instead of lean. Costs rise, but stability becomes the goal. That transition is inflationary by nature. Not hyperinflation, not collapse, but persistent pressure. Now here's where the current moment becomes especially important. This time, the world is entering this transition with record debt, aging populations, and slower productivity growth. That limits how governments can respond. They can't easily raise rates without stressing debt. They can't easily cut spending without social consequences. And they can't easily stop printing without slowing growth. Those constraints didn't exist to this degree in previous cycles. That's why precious metals are responding earlier and more aggressively. They are pricing in a future where policy options are narrower and trade-offs are harsher. This doesn't mean gold will rise in a straight line. Corrections will happen. Volatility is part of every transition. But once a structural shift begins, it rarely reverses quickly. Gold and silver don't predict exact dates. They reflect changing incentives. And incentives right now are moving away from trust-based systems toward asset-based security. For most people, the biggest risk during periods like this isn't market volatility. It's misunderstanding what's actually happening. When systems shift slowly, people assume nothing has changed. Life continues. Salaries arrive. Markets open every morning. And yet, purchasing power quietly erodes in the background. This is how most wealth is lost, not through sudden crashes, but through gradual dilution. Prices rise faster than income. Savings buy less each year. Long-term plans become harder to maintain. Gold and silver don't fix these problems. They signal them. They act as a measuring stick for the value of money itself. When precious metals rise steadily over time, it's often a sign that currencies are being asked to do too much. Fund debt, stabilize markets, support growth, and absorb political pressure all at once. Eventually, something gives. That's why preparation matters more than prediction. Trying to time tops and bottoms leads to frustration. Understanding the direction of change leads to resilience. Smart investors focus on balance. They don't abandon productive assets. They don't bet everything on one outcome. They diversify across risk types. Some assets benefit from growth. Others protect against instability. Gold and silver fall into the second category. Not because they generate returns, but because they preserve optionality. They give flexibility when conditions change. Now consider the psychological side of markets. When uncertainty rises, people rush for clarity. They seek simple answers in complex systems. That's when poor decisions are made. The role of calm analysis becomes even more important. This is why central banks act slowly and quietly. This is why institutional investors reposition over years, not weeks. The current precious metal rally fits that pattern. It's methodical, it's persistent, and it's unfolding without drama. Those are the most important clues. This doesn't mean fear is required. It means awareness is valuable. Because when confidence finally shifts publicly, prices rarely wait for consensus. By the time headlines turn loud, positioning has already changed. Gold and silver are moving now because the groundwork is being laid. The question isn't whether volatility will appear. It's whether individuals recognize the transition early enough to adapt calmly. So let's bring everything together. The surge in gold and silver is not a prediction of instant collapse. It is not a signal that the world is ending. And it is not a call for panic. What it is a message. A message that the global financial system is entering a new phase. A phase where confidence is no longer automatic, where trust must be managed carefully. And where stability is valued more than speed. Gold is rising because it reflects monetary reality, not optimism. Silver is rising because it reflects economic stress, not headlines. Together, they tell a consistent story. Debt levels are too high to ignore. Currencies are being stretched to solve structural problems. And governments have fewer easy options than before. That doesn't mean growth stops. It means trade-offs increase. In a world like that, capital becomes selective. Money flows toward assets that don't depend on promises, assets that don't require policy support, assets that exist outside political cycles. That's why central banks are acting now. That's why institutional investors are repositioning quietly. And that's why precious metals are moving before fear becomes visible. For individuals, the lesson is simple, but often overlooked. You don't need to predict the future perfectly. You don't need to chase every trend. And you don't need to react emotionally to every market move. What you need is perspective. Understanding that systems evolve, that financial rules change over time, and that preserving purchasing power is just as important as growing wealth. Gold and silver are not solutions by themselves. They are tools, signals, reference points. They help measure what currencies can no longer hide. And right now, that measurement is telling us something important. The era of effortless confidence is fading. The era of careful preparation is beginning. History shows that those who recognize transitions early tend to move calmly. Those who wait for certainty often move too late. This moment doesn't demand fear, it demands awareness. Because the biggest financial shifts rarely announce themselves loudly. They unfold quietly. Until one day, everyone realizes the world has already changed. If you found this breakdown valuable, take a moment to reflect on what these signals mean. Not just for markets, but for long-term financial thinking. This isn't about chasing headlines. It's about understanding the direction of the system and staying ahead of it.